Hello everybody and welcome to this discussion. In this section we will discuss about the concept of profit. Particularly we will discuss the importance of profit, factors affecting profit, types of profit and how to maximize the profit. It is obvious that maximizing a profit or making a profit is a mandatory for the organization. In order to exist in the business, in order to exist in the market, a business must make a profit. Earning a profit for the organization is important because the organization can get finance from financial institutions like a bank. It can also attract investors. Once a business can increase its profit, so it can attract investors to fund the business operation. The business can also grow itself by reinvesting the profit. By reinvesting the profit, a business can grow and can increase its market share also. In general, companies cannot remain in a business without getting a profit. Without making a profit, a company cannot exist in the market. So, doing or making a profit is mandatory to exist in the business. Profit is the difference between cost and revenue. That means total revenue that we obtain from the sales minus total cost. Let us start the types of profit. There are two types of profit, that is the accounting profit and the economic profit. Basically, these two types of profit is different in the consideration of costs. The revenue is the same in both profits, that is the total revenue, whereas in the case of accounting profit or business profit, the cost is the explicit cost. That means the explicit cost or accounting cost is the cost of the resource which involve direct monetary payment. That means explicit cost is revealed in the receipt of the goods or receipt of the resources. When we purchase goods or resources for our input, so we need to pay money. That cost is explicit cost or accounting cost that is revealed in the receipt. Accounting profit is shown up in the firm's income statement. Unlike that of economic profit, accounting profit can be seen in the income statement and it is reported by the accounting department or the finance department. Whereas economic profit is not revealed in an income statement, and economists consider not only explicit cost but also implicit cost. Implicit costs are implied cost or they are indirect cost. They are not revealed in the monetary form or they are not revealed in the receipt. So they are indirect cost. For example, the input provided by the owners, entrepreneurial effort, and the capitals invested on the business by the owner are indirect cost for the business. So these resources should be compensated. When we calculate the profit, these costs should be considered. An economist consider not only explicit cost but also such costs. such costs of indirect cost, implicit cost, or implied cost. We can define implicit cost as the cost of giving up the best alternative of use of resource. And usually it is very hard to measure. Therefore, managers often forgot them. They are not considering the implicit cost. Mostly they are not considering the implicit cost. Therefore, economic profit equals total revenue minus explicit plus implicit cost. Explicit plus implicit cost. Let us see some more details about explicit cost and implicit cost. In general, both explicit cost and implicit cost makes total economic costs. Total economic costs. Explicit cost of market supplied resources. When we want resources from the market, so we paid a money for the resource owner. The monetary payment which we are going to pay for the resource owners are explicit cost of the market supplied resources, whereas the implicit cost of owner supplied resource, this is the owner supplied resource, the owner of the business. This owner supplied resource, the cost of this owner supplied resources is implicit cost. The returns forgone by not taking the owner resource to the market. By the way, if we are not using for the business purpose, so we can take to the market to get some income. So that is implicit cost, implied cost, or indirect cost. An economist considers not only explicit cost, market supply resource, but also implicit cost of owner supplied resources. For example, the capital of the owner, the entrepreneurial effort of the owner, or other resource of the owner is implicit cost, which makes total economic cost. That means the total opportunity cost of both kinds of resource, both market supplied resources and owner supplied resources. Let's proceed. This is an example which shows the difference between accounting profit and economic profit. A garage run by its owner mechanic has a gross income of 20,000 and expense of 17,000, and the annual profit is 3,000. That is total income minus total expense. It will be 3,000. This profit is reported by the accountant. The accountant knows this profit, where there is a fixed investment, that is the investment in the building and the machine is 8,000. The prevailing rate of interest is 5%. That means that the fixed investment by the garage owner would have earned bir 400 a year had the business not been carried on. Might amount to another 200 bir a year. So if he didn't invest on the garage, so he can get the interest of 5% a year, that is 400 a year, and another 200 per a year, that is totally 600, while the owner might have earned 1,800 a year from his managerial and engineering skill. By the way, this one is the skill that he may sell by working for the other company. He can gain 1,800. Totally, he can, if he's not invested, if he's not invested on the garage, he may get 400 plus 200 plus 1,800, totally 2,400. He can get 2,400. So the economic profit is the accounting profit minus the implicit cost. The implicit cost by me, we mean by the implicit cost is the even we can consider also 8,000. If we consider 8,000, it will be actually negative. By the way, fixed investment is not considered as an operation expense because there is a depreciation cost, so we will divide according to the total period of time. This total cannot be calculated during a year. So we are taking operating expense and operating cost. That is, if a person is not investing on the garage business, he can get 2,400. So economic profit is equal to accounting profit minus implicit cost. Implicit cost, that means the missed cost or the indirect cost. The indirect cost of a business. Indirect cost. Let us see about economic profit. By the way, it is a more general definition of profit than that of accounting profit because it helps the manager to make proper decision. A manager needs to make proper decision based on economic profit rather than accounting profit. So effective managers should continually seek out the data to identify and quantify the implicit cost. As we said before, it is difficult to measure the implicit cost, but in order to be effective manager, we need to continually seek and quantify the implicit cost. By the way, economic profit can be zero, positive, and negative. Let us see the details. If the economic profit is positive, there is incentive for the firms to enter in the market. By the way, now I am talking about the free market. The free market. In free market economy, if the economic profit is positive, by the way, there is incentive for the firms to enter in the market, and in the long run, it will decrease the profit. The profit will decrease because more firms are interested and enter into the market because of the positive economic profit. If the profit is negative, there is an incentive for the firms to exit from the market. This is the opposite of the positive economic profit. If the economic profit is negative, it is better for the firm to exit the market rather than entering the market. If the profit is zero, that means in the long run, the economic profit, the positive economic profit will become zero. So if the economic profit is zero, there is no incentive to enter or exit. And it is a normal profit. We can consider as a normal profit. In the long run, the positive economic profit will be changed to zero profit. Zero economic profit. That is the normal profit. Because more firms are interested in, more firms become interested in the positive economic profit, and the economic profit becomes zero in the long run. These are the factors that affect the profitability of the firms. For example, the cost of the production affects our profitability, whether our profit increases or decreases. If the cost is high, so we can have reduced amount of profit, and if the cost is less, so we can have high amount of profit. And all the factors can affect the profitability of our firms. Economic profit role in market-based economy. If there is positive economic profit, it is a signal to resource holders where that outputs are most highly valued by the society or industry. So the business should increase the output, and the business need to expand the facilities in order to increase the output to get high economic profit, because the new competitors or the firms become interested due to the positive economic profit. Actually, positive economic profit is a measure of effectiveness and efficiency of the business, but not the most perfect measure of the business efficiency. It's not the most perfect measure of the business efficiency, rather it is just a measure of effectiveness and efficiency, but it's not accurate. And it is important reward for innovation and efficiency, and it is also helps for the organization to make research and development. As we said, it's not an accurate measure, but it can measure the performance in general. It can measure the rough performance of the organization. The market structure determines the profit of the business. There are two major categories of market structure, that is perfect competitive market and imperfect market. Under imperfect market, there are subcategories, for example, monopoly, oligopoly, and so on. In perfectly competitive market, economic profit can be positive in the short run because of the positivity of the economic profit. Other firms become interested in that business and they enter to the market, and in the long run the economic profit becomes zero. That is the normal profit because of the new entry of the firms. The entry of the new firms makes the positive economic profit to zero or normal profit, which drives the market price to be low. By the way, normal profit is a situation where a firm makes sufficient revenue. That means zero economic profit does not mean loss. Zero economic profit or normal profit doesn't mean loss. It is a situation where a firm makes sufficient revenue to cover its total costs and remain competitive in an industry. So zero economic profit doesn't mean loss. In the case of imperfect market, firms cannot easily enter and exit from the market. There are barriers to entry. So the business in the market can get high profit because of their barrier to entry. Firms can earn positive economic profit due to the barriers to entry. There are barriers for the coming firms, so the market power of the firm can get high economic profit. Here there is lack of competition because of the barriers to entry. Now let us see profit maximization. Profit maximization is a process by which a firm may determine the price of the output. That means the input and the output levels that lead to the highest profit. That means the optimum level of price that is accepted by the customers and competitive in the market. Maybe the amount of input and the output levels that leads to highest profit. There are different techniques for the profit maximization. The first one is MC, managerial cost equals managerial revenue method, and the other is total cost, total revenue method. We will see some more detail about managerial cost equals managerial revenue method. Managerial cost is the additional cost incurred in producing one more unit of the input. The cost incurred due to the additional one more unit of the input. One more unit of the input. And managerial revenue is the additional revenue. The additional revenue earned by selling one more unit of the product. The last unit of the product. The last unit of the product. Managerial revenue, the revenue by the last unit of the product. Whereas managerial cost is the cost incurred by the last unit of the input. The last unit of the input. Let us see one example. This is an example which shows that the profit can be maximized at the point where the marginal revenue equals the marginal cost. Here is the marginal revenue in this column. That means the revenue obtained by selling one more unit of production, and marginal cost is the cost incurred by one unit of input. This one is the marginal cost, and this one is the marginal revenue. And here is a profit column. This one is a profit column. In the profit column, as we see here, this one is the point of maximum profit. The point of maximum profit is obtained when the marginal revenue equals the marginal cost. The marginal revenue equals the marginal cost is a point where this is all about today's discussion. If you want to read further, you can read these books, and have a good day. Bye.